My name is Vikas Shukla, and in today's video I'm going to walk you through the math behind a multi-family rental business in US. It's applicable to other countries as well, but I will talk about the US. The typical figures and examples are based for the US. So what we are trying to see here is the fundamental problem is, let's say I have $100,000 cash in my hand, or maybe a little more or less than that. And then what I'm trying to do is trying to see how much annual return I can make using any business whatsoever. If I'm like a more or less a passive investor, I could invest it into let's say CDs or any other things. But now the interest rates are so low that it makes no sense to keep that money into a bank. So what are the other options? Gold could be other option, but it's uncertain. And then the stock market is another option. It's a good option actually, but today, as of I talk about 21st August, the stock market is an all-time high. And it's true that the stock market could give in the very long term a good return, but it's again a risky affair, especially since it's an all-time high. It could still go up high, but there's a good chance it could also come down. So that brings me to this multifamily rental income business. And why I'm doing only multifamily rental business, because I have been doing it for some time, and it looks like the multifamily is the way to go, because the rate of return could be a little higher than a single family home. And we will, for that's the reason, and that's the purpose of this whole equation that I will put and explain to you, and that you can also do your own calculation, and that based upon my experience. So to start with, I have a 100K down payment. Typically, when you want to buy a multifamily home, you typically have to make a down payment of 20%, which means I look a home of like 500K, maybe a little lower, higher or less, then I have to pay a 100K down payment. The rest of the 400K, that we are going to take a mortgage loan. The good thing is that the current interest rate is quite low, and you should take advantage of it. I am taking a higher interest rate. That's for the purpose of explanation, and it's not too far away. But one thing you need to keep in mind, that the interest rates for the rental property is substantially higher than your own home mortgage loan for the home that you live in. So if the home mortgage loan for your regular home is 3% typically, or 3 to 3.5%, the rental property home interest rate will be like 4.5%. This is 1% or so difference between the rental property and the regular property. And before I proceed more about it, I want to clarify that I'm not a CPA. I'm not your financial advisor. I'm just giving these thoughts based upon my experience. I'm sharing my own story, and it could be factually totally incorrect. The figures, the interest rates, and all these calculations could be totally incorrect, and you should consult a licensed CPA if you are going into this business for tax, finance related advice. With that being said, this, in my opinion, if you are, let's say, and this for an example, and that's very real and close example, if you are taking a $400,000 mortgage, every year, what I'm going to do is I break up my business into two parts, and we need to be very clear about what is my income and what is my expense. And then at the end of the year, I'm going to calculate how much money, how much net profit I'm going to make over the 100K investment. So let's say this 500K home is a 3-family home. You could have a 2-family home, you could have a 3-family home, or you could have a 4-family home. More than 4-family home, at least in the state that I live in, Massachusetts, it is counted as a kind of a business, or it's not your self-passive business, but and they have a separate category that gets difficult to manage from the law. For example, you need to have by law required to have a fire alarm system and automatic sprinkler, or similar rules could exist in other states or towns. So let's say this is a 3-family home for a 500K home, and every single home is paying you $1,500 per month of rent. Now, this is going to be different for every single city, every single town, depending upon the location. This price could be higher, this rent could be lower, or the price could be lower, rent could be higher, and that's something you need to calculate. What you need to do is go to Zillow.com, go to Redfin.com, or go to other websites and look out what the rent for that particular home is, and that you are interested into it based upon the number of bedrooms and the number of bathrooms, the locations, and all these things, and get this a good feeling of those numbers. If you are in the town that you live in, you should have a very good idea of what a particular home should that rent fetching. So let's hope it's $1,500 per month. Then if you have 3 family, and let's say all three family homes, they fetch you $1,500. That brings you $4,500 for the whole family every single month. Now you need to multiply this figure with 12 months. You get $54,000 per year. That is your income. Now we need to see what are our expenses. So to simplify it, I will take a little higher expenses to keep it a little bit of margin for unforeseen expenses. So I am putting my interest rate a little higher than normal, and there's the purpose for it. I will explain that to you later on. So the 5% means on 400K mortgage, I am paying $20,000 per year just on the interest, and it will come to happen. That's the first year. I'll come back to it and then discuss what happens in the later years. We need to have an insurance because the tenants can sue you anytime, and you must have, there may be fire incidents and so on and so forth. And so $4,000 is a reasonably okay expense. It's not ultra low, but at the same time there are expensive insurance also that could go higher depending upon your area. So $4,000 is a roundabout figure. Now the tax, this is a highly variable expense, and that will depend upon the town you live in, the locality you live in, and that will how good the schools are. The $4,000 is the ballpark figure, and that will depend again upon town to town. It could be as high as $8,000 or $9,000 in some of the times. So you need to put down your figure right here. And then you need to pay for water that your tenants will be using. So the water is usually the homeowner's responsibility. It's not the tenant's responsibility. So that is typically $3,000 based upon my experience. So, and then this maintenance, I'm putting $12,000. In some years, in some of the times, this maintenance it requires all kind of maintenance. Sometimes the toilet will break down, the water will stop, water starts leaking, some of your gas stove will stop working, electricity not working. Some of the maintenance like it could be your garden, your doors, your alarm, and so many other things. What happens is sometimes your heating system will break down. So sometimes what happens is that your expenses are quite big. The other times it will be low. Sometimes every maybe 20 years you need to repair your roof, and if you are unlucky, you have to replace in a couple of years of entry, then that's a big expense. So $12,000 it takes care of a little higher expense. There is few things. If you have a hands-on experience on doing some maintenance yourself, for example, painting a little bit of door lock maintaining those, or maybe a few simpler tiles chip broken, those kind of repairs, and you could save a lot of things. But then it depends upon if you are free and able to do that. So let's say if I add these things, then I have 4 for 8 plus 3, 11 plus 2, 13, and 1, 448 plus 1 9 and okay, no, I 4 plus 2. Anyway, let's do a quick calculation. 28,000 and plus 3,000. 28. This is actually, I think I miscalculated it. So 28,000 plus 12,000. That's 40,000 and plus 3. This is 43,000. Okay, let me calculate it again. So this is 4 plus 4, 8 plus 3, 11 plus 2, 13, 1 here, 2 plus 1, 3 plus 1. So it's 43,000. So the expenses are 43,000 and my income is 54,000. What it means is that my net gain is 11,000. So I spend 100K and every single year, for first year, I make a profit of 11% of return, and that's I'm going to put 11% profit. Now you see that this in one particular case is a reasonable amount of profit. It's not huge, it's not very great, but it's reasonably better than, slightly better than probably the stock market long-term return, and better than many other investments. But those figures that I have put in, they will have a huge value. What you want to do is put up an Excel sheet, put up all those figures in an Excel sheet and be very precise, as possible, keeping the maintenance also a variable, and then tweak the figure. What you could do to maximize this profit. For example, your maintenance could, instead of 12,000, I could put it a figure like 11,000 by doing some of my maintenance on my own. My expenses go to 42,000 and my profit increases from 11% to 12%. I can get a better interest rate, let's say 4% now instead of 5%. This figure goes down to 16,000. I make 4,000 less profit, which is like 38,000. Now, if I put 38,000 here, I make $16,000 profit, and my rate of return goes up to 16% per year. This is a very decent amount of return. There are few finer things that you need to keep in mind, and I will discuss those things with you. So this 100K down payment, when you pay this thing, you need to pay a closing cost, which is like a cost associated with your mortgage when you close. When you take this much of home, you typically pay like $3,000, in some cases $4,000 of closing cost. Then this is an initial $104,000. Then you are earning whatever $11,000 or $12,000 is on the basis of $104,000. So your percentage return will be accordingly, it will go down. And then sometimes the home that you buy, they have a lot of works required. For example, the roof may be broken, maybe the heating system is broken, the water heaters are broken, you need to get it repaired. And that means, let's say, you need to pay $10,000 upfront to get those fixes done. Then as you see, if you, for example, instead of 100K, you end up paying 120K in closing cost and repair cost. And if you are making 112,000 of profit, then your rate of return goes down from 12% that we calculated earlier to like 10%. So those variables play a lot of role. Sometimes this 500K is that for one particular locality, it's not 500K, it's like 800K. And if you do the whole calculation for 800K, it will turn out that the profit is only 6% or maybe even 8%. So the whole thing has a lot of variable, and it depends upon town to town. The one town which is like a very good town, centralized town like Boston or some places, they will have a very expensive home. You get a very good rent also in that, but then the equation do not work simply because the home is so expensive that the mortgage and everything, it out I mean it outsmarts our gain. So this again it depends upon town to town, and then you need to take into account all those things into account. Some of the expenses that I have not mentioned in these must bear into mind that this is your responsibility. For example, trash expenses is usually the tenant's, it's a homeowner's responsibility. If your home has a central heating system, then especially in a multifamily, that is also your responsibility, and then you need to take that into account. And although I put all those things into maintenance cost, and that's why I kept a relatively higher number for the maintenance cost. For example, the heating cost can easily go to like $3,000 or $4,000 per year. I mean, you only run it for like 7 or 8 months, but that gets expensive. Then there could be then there's the finance and tax things, tax and recording things. At the end of the year, you contact your CPA to file the taxes or keep the book recording for you. There is also possibility that if you don't want to do all those management, the home management, collecting rent from the tenants and taking up the call when they call for the home maintenance yourself, you could hire a company to do all those work, and they charge you something like maybe $400-500 or whatever X $100 of this, and then that will also adds up into the maintenance cost. If you do it yourself, you will have to have a good contact of the plumbers, all those persons who could go to the home and make that repair. You should have a plumber, an electrician, or a general maintenance person to do all those work for you. If you hire a property management group or a company, then they will do it, but they will charge higher, and then your profit could go down. So, other than that, this rental property is a good business. There are few problem areas that you should be prepared for this, because I have faced a problem and you could also be facing a problem. Not all the time you get very nice behaving tenants. Sometimes they have the financial problems and they are not able to pay you, and then you have a dilemma whether to give them a notice to get out or just be sympathetic with them and lose your financially. Sometimes the tenants they try to find a way to sue you, to bring you to the court, and in the return they will like to get some kind of rental waive off or something like that. So those problems when come from, it's really a serious kind of stress. You could be into serious stress, and you will think that this whole business is not worth doing that. Other than that, there could be some unforeseen problems. There could be, for example, your heating system can suddenly break off, and then you don't have any idea of how to get this fixed and how to find the right person to fix it and something like that. Besides that, there are a few more things that I wanted to point out, and one of them is the depreciation at the end of the year. And again, I'm not your CPA, and I don't want to say that what I'm doing is there's something that I want to give advice, but this is something you need to consult with your CPA, a certified CPA or a licensed CPA. So basically, your home has some value of $500K or something, and at the end of the year, when you find that you have $16,000 of profit, that profit gets added to your income, and then you have to pay a tax for it. And one way to reduce the tax, and you should almost always be doing it, as your CPA will tell you, is called a depreciation. So you divide this 500K number by 27.5. We hope that this is the life of that home, and then every single year you take that money out of that from this your profit to reduce your taxes. So in most cases, if you do this depreciation and if you calculate all of your this rest of the things, your profit should come close to zero. But when you sell that home, that is a different, and I will create a different video for that, about how your long-term capital gain tax. But you should ideally be consulting a CPA for that. So you should always document all your expenses, and that should include your mortgage interest expense, your insurance tax, water maintenance, anything that you pay to someone who do the fixes for it, any Home Depot receipts. And then there will be two categories of expenses. The one is day-to-day expenses. For example, your bulb is you are replacing that, anything that wears off on a yearly basis or like that. But anything that is going to take a long-term improvement, that you cannot take all of that expense out of your yearly profit. They will be like you will take a depreciation of it. For example, you have a refrigerator. That will have something like a 10-year. You will divide that expense into the life of that refrigerator and take a little bit off every single year. So those are the basic accounting thing. For more detail, you should consult your CPA. But this is just to give you a general idea of what you should be doing basic financing. And then at the end of the year, you will also be paying your finance and per person some amount of that will eat up your profit. So this is my assessment. One thing I did not make is that when you make your mortgage payment, you're not only paying your interest, but you are also paying the basic part of it, mortgage. So basically you will be paying the principal plus the interest. Now if you look into you are also paying principal, and that will be higher or lower depending upon you have a 15-year mortgage or a 30-year mortgage. You'll see that your profit, all your profit is going into more or less into your principal. So essentially you are not getting anything in your hand. So what happens is that principal goes on reducing your balance mortgage, and then you build up something we call as an equity of the home. That's number one. Number two, like for example, let's say if I divide this figure of 400K by, let's say, 30, if it's a 30-year mortgage, then divide it by 30, you become like 30K every year. So you are getting an equity. We call it an equity because that's something that you own it. So that 30K, it keeps adding every single year. And what happens is next year the 400K mortgage, it reduces by 13K, and you pay a smaller amount of interest in coming year. So you can think of that. Your profit keeps increasing year after year. Your equity keeps increasing. And the one thing that's very helpful is that this equity then can be useful for you in your unforeseen circumstances, or you can leverage it to make some big profit. For example, if the stock market suddenly crashes to a way low, for example, today it's 3,300 S&P 500 or 34, close touching to near to 3,400, it crashes down to, let's say, maybe 2,500 or even lower, 2,300. At that point of time, you can take the equity that was created, this 13K, you can take this loan from this mortgage and then invest it into the stock market and maybe pay a smaller interest like 4%, but you could make a much bigger profit in the stock market. So this is one way you could profit from the rental business by potentially investing into a stock market when the market is low. So these are some of the points that I touched upon, and it's based upon my experience. But again, I hope you will find it helpful. But if you have any questions, that leave in the comment section and I will try to answer those. Thanks for taking a look.